I'm going to start this story with something uncomfortable. Your parents were told a simple promise: work hard, put money into a 401k, collect Social Security, retire. For a long time, that promise worked well enough. But here's the quiet truth most people don't like to face. Statistically, it will not work the same way for you. Not because you're lazy, not because you made bad choices, but because the math underneath the system has changed. And the system never bothered to tell you. Most people were never taught how money actually works. They were taught how to follow instructions, contribute to the plan, pick a fund, don't ask questions, trust the process. That was fine when the process had room for error. It doesn't anymore. Today, we're staring at the largest retirement gap in modern American history. More people than ever are working longer, retiring later, and quietly realizing they don't have enough. And strange as it sounds, that crisis is also creating an opportunity. Not a guaranteed one, not a magical one, but a real one. An opportunity created by money moving away from where it used to live. Let's slow down and define one thing clearly. Retirement is not an age. It's not 65. It's not 70. It's not whenever the calendar says you're allowed to stop working. Retirement is a math problem. It's the moment when the income produced by your assets can cover your life without your paycheck. That's it. When your investments pay your bills, you're free. When they don't, you're not, no matter how old you are. The old plan assumed Social Security plus a steady 401k contribution would be enough to cross that line. The new reality is harsher. The market is near record highs, yet millions of people are closer to retirement than ever and further from security than they expected. This isn't bad luck. It's structural. There are three quiet forces working against the traditional retirement plan: fees, returns, inflation. Each one seems harmless on its own. Together, they quietly drain decades of effort. Let's talk about fees first. Because they're invisible. Most 401k accounts under $1 million pay around 1% per year in total fees. Sometimes more, rarely less. 1% sounds trivial, almost polite. But it's not 1% of the final balance. It's 1% of every dollar every year, including the growth. Imagine investing $500 a month for 35 years. You do everything right. The fund performs well. On paper, the account grows to around $1.6 million. Then fees take their cut. Quietly, automatically, relentlessly. By the end, roughly $400,000 is gone. Not lost in a crash. Not stolen. Simply paid out over time. You didn't feel it. You didn't see it, but it happened. And here's the uncomfortable part. Even after that, the numbers still look decent, until you adjust for returns. Most people assume their 401k grows at stock market averages, around 10%. In reality, the average 401k earns closer to 8% before fees. Why? Because many funds are blended with bonds. Bonds dampen volatility, which feels safe. They also dampen growth. Safety has a price. Now run the numbers again. $500 a month. 35 years, 8% returns, minus fees. You don't end up with over $1 million. You end up with around $780,000. And that's when inflation steps in. $780,000, 35 years from now, is not $780,000 today. Assume long-term inflation averages 3%. That's conservative by historical standards. Suddenly, your future nest egg feels smaller. In today's purchasing power, that $780,000 looks closer to $275,000. Better than nothing. Better than zero. But not enough to replace a lifetime income. This is the moment where many people feel something shift. They did what they were told, they followed the plan, and the plan quietly changed underneath them. That realization is spreading, and when realizations spread, money moves. People aren't abandoning 401ks, they're supplementing them. They're looking for returns that fees and inflation can't quietly erase. This is where opportunity appears, not because alternatives are safer, but because more people are forced to look for them. Wealth grows from three variables: time, money, return. You can't rewind time. You can only earn and save so much. Return is the lever most people ignore. Change where money is invested and the entire equation changes. That's why alternative assets are getting attention, not because they're new, but because the old paths are crowded and underperforming. Let's start with the most accessible shift: active investing. This isn't day trading. This isn't chasing headlines. This is owning specific businesses instead of bundles of averages. When you buy a fund, you accept the winners and the losers, you pay for management, you accept the blended result. When you invest directly, you become the filter. It takes more effort, it takes more learning, it comes with more risk. It also removes layers of cost and dilution. Even small improvements in return compound into life-changing differences over decades. Remember that 1% fee? Now imagine earning 1% more instead. The math flips. The danger is how most people do this. They wait until a company is everywhere. They hear about it on the news, they see it trending online. By then, much of the upside is already priced in. Smart investing usually happens quietly, long before excitement arrives. That's why research matters more than predictions. The second accessible shift is geographic. For decades, American investors barely needed to look elsewhere. The US market dominated growth. That dominance is no longer guaranteed. Other economies are growing faster from smaller bases. Smaller economies can grow more quickly. Smaller companies can scale faster. That doesn't make them safe. It makes them asymmetric. When a growing country and a growing company move together, returns can surprise people. International exposure used to be optional. Now it's becoming structural, not because the US disappears, but because growth disperses. Some investors take this exposure broadly. Others focus on emerging markets where volatility is higher and growth potential is larger. None of this comes without risk. But risk already exists in doing nothing different. That's the part most people miss. At this point, many investors step into the middle ground. Assets that don't trade minute by minute on the stock market. Private real estate, private credit, crypto. Each one solves a different problem. Private real estate removes daily price swings. Properties don't reprice every second. Cash flow becomes more visible. Volatility feels lower, even when risk still exists. Private credit flips the script. Instead of owning businesses, you lend to them. You earn interest. You get paid before equity owners. Returns come from contracts, not optimism. Crypto sits in a category of its own. Young, volatile, unproven over long cycles. Yet impossible to ignore because of capital flows and infrastructure growth. None of these are silver bullets. They are tools, and tools matter when the old ones stop working, as expected. Beyond that lies the advanced layer. Startups, rental properties, metals, entire businesses. These are not passive in the traditional sense. They demand attention, patience, and tolerance for failure. Most startups fail. Some return nothing. A few return everything. That skew is the point. Real estate rewards effort with tax advantages and leverage. Businesses reward ownership with control and cash flow. Metals don't produce income. They preserve purchasing power when trust erodes. Each asset answers a different fear. Loss of income, loss of value, loss of control. What matters is understanding why money is moving. People aren't abandoning the system out of rebellion. They're responding to arithmetic. When enough people respond to the same arithmetic, demand shifts. And when demand shifts, prices follow. This doesn't guarantee success. It guarantees change. And change is where opportunity always hides. This script is built using the structural and stylistic framework defined in the project's master prompt, and it draws thematic direction from the provided transcript while reinterpreting, expanding, and contextualizing its ideas under fair use. The next part will walk deeper into how to think about risk without fear, how to layer assets without chaos, how to avoid the most common traps people fall into when they realize the old plan isn't enough. There is a moment most investors reach that no spreadsheet prepares them for. It's the moment you realize risk never disappears. It only changes shape. Keeping everything inside a 401k feels safe because it's familiar. But familiar does not mean low risk. It means slow risk, quiet risk. The kind that shows up 20 years later when the math no longer works. Real investing starts when you stop asking, is this risky, and start asking, what kind of risk am I taking? Market risk moves prices up and down. Inflation risk erodes purchasing power. Concentration risk ties your future to a single outcome. Ignorance risk comes from not understanding what you own. Most people unknowingly carry all four. The goal is not to eliminate risk. The goal is to distribute it. That's why layering assets matters, not stacking everything into one idea, not chasing whatever just worked, but spreading exposure across different engines of return. Some assets grow, some assets pay, some assets protect. Growth assets are volatile. They feel uncomfortable. Stocks, startups, emerging markets, They move before they make sense. Income assets are boring. They send cash. Rentals, private credit, dividend-paying businesses. They don't make headlines, but they reduce pressure. Protective assets don't excite anyone. They don't compound fast. Metals, cash equivalents, hedges. They exist so you don't panic when everything else shakes. Most people try to build wealth using only one of these. That's why they feel stuck. A portfolio built only for growth feels terrifying during downturns. A portfolio built only for income grows too slowly. A portfolio built only for safety quietly falls behind. Balance isn't about equal amounts, it's about purpose. Each dollar should have a job. And this is where many people make their biggest mistake. They confuse complexity with sophistication. They add assets without understanding them. They chase yield without reading terms. They follow influencers into deals they can't explain. This is how people lose money while thinking they're being smart. The solution is slower than people want. Understand before you allocate. Start small before you scale. Expect discomfort before results. Alternative assets are not shortcuts. They are side roads. Some are smoother, some have cliffs. Another common trap is timing. People wait for perfect conditions. They wait for clarity. They wait until risk feels gone. It never does. The biggest shifts happen when uncertainty is highest. That's when assets are mispriced. That's when narratives lag reality. But that doesn't mean rushing blindly. It means preparing early so action feels boring when the moment arrives. The quiet advantage always belongs to the prepared. One more truth that matters. Wealth rarely comes from one decision. It comes from a series of reasonable decisions that compound over time, lowering fees, improving returns slightly, diversifying income sources, avoiding catastrophic mistakes. None of these are exciting on their own. Together, they change outcomes completely. This is why the retirement crisis is not just a warning, it's a signal that the old assumptions no longer hold, a signal that money is searching for new homes, a signal that financial education is no longer optional. Those who adapt early don't need to predict the future. They simply need to position themselves so they benefit from change instead of being crushed by it. The goal is not to beat everyone else. The goal is to not be trapped by outdated math. That's the passive path. If there's one thing to take away from this, it's simple. The old rules didn't disappear. They just stopped being enough. Understanding that puts you ahead of most people already. If this video helped you see money a little more clearly, take a second to like it. It tells the algorithm this conversation matters. Subscribe if you want more calm, honest breakdowns like this. No hype, no shortcuts, just clear thinking about wealth and freedom. Leave a comment and share how you're thinking about your own path. I read them, and they shape what comes next. And if someone you care about is still relying on outdated assumptions, share this video with them. It might be the nudge they didn't know they needed. Good luck on your journey. Truly. Feel free to explore other videos on the channel if you want to go deeper. I'll see you in the next one.